Ever wondered why your investments sometimes sink, even when the company seems solid? You've done your research, but your shares still drop. It can feel like you're sailing a good ship straight into a storm you never saw coming. This isn't just bad luck, it's the result of powerful, invisible forces in the financial markets. Investing is like sailing from Marseille. Sometimes the sea is calm, sometimes a storm hits out of nowhere. In finance, these are called risks. Some affect everyone, others just a few. The key is knowing the difference between a market-wide storm and a problem with your own boat. The two big types of risk: market risk and idiosyncratic risk. Think of market risk as the weather for the whole sea, and idiosyncratic risk as a leak in your own boat. And let's dive into the first one. Market risk is like the tide in the Calanques. When it rises or falls, every boat is affected. You can't escape it by picking a different company. It impacts everyone. These are the big picture events: political shifts, recessions, interest rate changes, or global crises. When these happen, nearly all investments can drop together, no matter how well managed the company. For example, a Eurozone interest rate hike makes borrowing expensive for all, slowing the economy and pushing share prices down, or a global recession, like in 2008, hits every sector everywhere. This is the risk you accept by investing at all. You can't eliminate market risk, but you can prepare for it. It's the background hum of the economy. Now, let's look at the other kind of risk. What if the sea is calm, but your boat springs a leak? That's idiosyncratic risk, unique to a single company or industry. It's caused by internal events, a product recall, a CEO's departure, a factory fire, or a lawsuit. For example, if a Marseille soap company's factory burns down, its shares drop, but Airbus isn't affected. Or a biotech firm fails a drug trial, bad for them, but not for the wider market. On the flip side, a shipping company landing a huge contract could see its shares soar, even if the market is flat. Idiosyncratic risk is all about the individual story. The good news, you can actually do something about this kind of risk. Let's see how these risks play out together. Imagine you invest in Pernod Ricard and a Marseille tech startup. Suddenly, the European Central Bank hikes interest rates, a classic market risk. Both investments drop. Then the tech startup faces a lawsuit for stolen code, an idiosyncratic risk. Its shares plummet, but Pernod Ricard is unaffected. The interest rate hike was the storm that hit all boats. The lawsuit was a lightning strike on one. If all your money was in the tech startup, you'd face a huge loss. But with shares in different companies, the damage is contained. This story shows why understanding both risks matters. Market risk is unavoidable. Idiosyncratic risk can be managed. So what's the best tool to protect yourself? Enter diversification. You can't stop market risk, but you can build a better boat, or better yet, a fleet. Diversification means not putting all your eggs in one basket. By spreading investments across different assets, you reduce your exposure to company-specific disasters. If one company fails, others can offset the loss. Imagine owning shares in Pernod Ricard, Total Energies, LVMH, and a government bond. A single failure becomes a blip. Diversification works wonders on idiosyncratic risk. You can nearly eliminate it by holding a broad portfolio, like a low-cost index fund. If one company goes bust, it barely dents your overall value. This is why financial experts always stress diversification. It's your number one defense. But what about market risk? Diversification is your best defense against company-specific risk, but it can't shield you from market risk. If the whole economy tanks, even a diversified portfolio will drop. Diversification is a lifeboat, not a submarine. It helps you survive storms, but you're still in the sea. When a market crash hits, everything tends to fall together. Diversification smooths out the ride, protecting you from catastrophic single company losses. But it can't eliminate the risk of losing money in a downturn. The reward for investing is the return you get for accepting market risk. The goal isn't to avoid all losses, but to build a portfolio that matches your goals and risk tolerance. Accept market risk as the price for long-term growth and use diversification to strip away unnecessary risks. Only take the risks you're likely to be rewarded for. So what should you do? Focus on what you can control. Like, you can't control the economy, but you can control how much idiosyncratic risk you take. The easiest way, diversify with low-cost investment funds, like a global index tracker. This gives you instant exposure to thousands of companies, minimizing the risk of any single failure. Market risk is the tide, idiosyncratic risk is the leak. Diversification plugs the leaks. Invest for the long term, accept market ups and downs, and let diversification protect you from disasters. Build your ark, respect the tide, and sail confidently toward your financial goals. That's how you stop sailing blind.